I downloaded a Forex trading bot that had a 5-star rating, over 4,000 purchases, and a backtest showing a 340% return over 3 years. I ran it live for 6 weeks. It lost 22% of the account. So I did something most people don't do. Instead of just moving on and blaming the market, I went inside the code. I pulled apart every single rule, every condition, every trigger, and I mapped out exactly how this thing made decisions. And what I found was not a scam. It was something almost worse. It was a bot that was perfectly designed, just not for the real market. It was designed to look good on a chart that already happened. And that distinction? That is the entire reason 90% of these things fail. Today I'm going to walk you through exactly what I found, and more importantly, what it means for anyone who is thinking about using, buying, or building a trading bot. Before we get into the reasons, let's level set on what a Forex trading bot actually is, because there's a lot of confusion around this. A Forex bot, also called an expert advisor or EA if you're using MetaTrader, is a piece of software that follows a fixed set of rules to open and close trades automatically. It monitors price, applies conditions, and executes without any human emotion or hesitation. That sounds ideal, right? No fear, no greed, no second guessing. And in theory, it is. The problem is not the concept of automation. The problem is in what rules these bots are actually following and how those rules were created. Let's talk about reason number 1, curve fitting, also called overfitting. When a developer builds a bot, they test it against historical data. They tweak the parameters, things like moving average periods, RSI thresholds, stop-loss distances, until the equity curve looks beautiful. A smooth diagonal line going up and to the right. The problem is that what they've actually done is teach the bot to be an expert at trading the past. They've optimized it so specifically for data that already happened that it has essentially memorized that data rather than learned anything transferable from it. Think about it this way. Imagine you're studying for a test and instead of understanding the subject, you just memorize the exact answers to last year's exam. You'd ace the practice run. But when the new exam comes with different questions, you're lost. That is exactly what curve fitting does to a trading bot. The more optimized a backtest looks, the more suspicious you should be, not more impressed. When I opened the code on the bot I tested, I found dozens of hyper-specific conditions. Things like, only trade if the 47-period moving average is above the 112-period moving average, and the RSI on the 15-minute chart is between 52 and 61. Why those exact numbers? Because someone ran thousands of optimization passes until those numbers produced the best backtest result. They don't mean anything fundamentally. They're a scar from over-optimization. Reason number 2, backtesting is, at best, a rough approximation of reality. Even if a developer avoids the worst of curve fitting, their backtest still has serious limitations that most people never think about. First, most backtests use data that assumes every trade fills instantly at the exact price shown on the chart. In real trading, there's slippage. Your order doesn't always fill where you expect, especially during news events or in fast-moving markets. Second, backtests almost never accurately model the spread, the difference between the buy price and the sell price, at every single moment in history. Spreads widen dramatically during volatility. A bot that looks profitable in a backtest with a fixed 1 pip spread might be deeply unprofitable when spreads spike to 5 or 8 pips during real market conditions. Third, there's something called look-ahead bias, where the historical data used in the test was processed in a way that gave the bot just a tiny bit of information it shouldn't have had. Even fractions of a second matter when you're writing algorithmic logic. The result is a backtest that's fundamentally lying to you. Not because anyone is trying to deceive you, but because the simulation just isn't the real world. Reason number 3 is one most bot sellers will never bring up. Broker dependency. A Forex trading bot does not exist in a vacuum. It exists inside the infrastructure of a specific broker, and brokers are not all the same. They have different execution speeds, different requote policies, different spread structures, and some, particularly dealing desk brokers, can actually trade against your positions. A bot that was developed and tested on one broker's data feed and infrastructure can behave completely differently when deployed on another broker. Things like latency, the tiny delay between when the bot sends an order and when the broker executes it, can be the difference between a profitable trade and a losing one for strategies that depend on precise entry timing. Affiliate, broker. This is exactly why the broker you use matters enormously, and why I only trade and recommend brokers with true ECN or STP execution where you can verify your fills. I'll link the broker I use in the description. They offer genuine execution transparency and consistently tight spreads, which is what any serious automated or manual strategy needs to perform as designed. Reason number 4, bots don't adapt. Markets do. This might be the most fundamental problem of all. Financial markets are not static. They shift between trending conditions and ranging conditions. Volatility expands and contracts. Correlations between currency pairs change based on macroeconomic cycles, central bank policy, geopolitical events, and 100 other variables. A bot built on a fixed rule set is frozen in time. It will keep doing the exact same thing regardless of what the market is doing. The bot I reverse engineered was essentially a trend-following system. It worked well from 2020 to 2022 when we had strong, sustained directional moves driven by pandemic-era monetary policy. But from mid-2022 onward, when markets became more choppy and policy-driven with sudden reversals, the bot got chopped apart. It kept buying breakouts that immediately failed. It kept holding trades through reversals because its trailing stop logic hadn't been designed for that kind of volatility profile. No one updated it. Why would they? It had already been sold thousands of times. A professional discretionary trader would have recognized the change in market conditions and adjusted their approach. A bot can't do that unless it's been specifically programmed with adaptive logic, and almost none of the retail bots on the market have that. Reason number 5, and this one is the silent account killer: flawed risk management. Most retail bots use one of 2 approaches to position sizing: fixed lot size or martingale scaling. Fixed lot size is at least safe in that it won't blow your account in one series of trades. But martingale scaling, where the bot doubles down after every losing trade expecting the market to eventually reverse, is one of the most dangerous strategies in existence. It looks amazing on a backtest because in historical data there's almost always eventually a reversal. But in live trading, a sustained trend or a series of correlated news events can produce drawdowns that a martingale bot simply cannot survive. The math is brutal. Double your position size 7 times and you've multiplied your original risk by 128. One bad streak and the account is gone. Many of the bots I've looked at use some version of this, sometimes hidden under softer language like recovery mode or smart scaling. Read the documentation carefully. If the position size increases after losses, walk away. So what actually works? Here's the honest answer. Sustainable trading, automated or manual, requires 3 things that most bots skip entirely. First, a strategy built on a real market inefficiency or structural edge, not just optimized historical patterns. Second, realistic execution conditions that reflect how your broker actually fills orders. And third, proper risk management that protects capital across all market regimes, not just the ones the backtest happened to include. If you want to build those skills yourself, understanding how institutions move price, how to read order flow, and how to structure a strategy that holds up in real conditions, I recommend the course linked in the description. Affiliate course. It's the closest thing I've found to learning how traders at the professional level actually think, rather than just regurgitating retail indicators and hoping for the best. The appeal of a trading bot is completely understandable. Set it up, walk away, let it print money while you sleep. But the market doesn't reward convenience. It rewards edge, discipline, and adaptability. The bots that fail, and it's most of them, fail because they were designed to look good in a demo environment, not to survive in a live one. If you take one thing from this video, let it be this: a beautiful backtest is not evidence of a good strategy. It is evidence that someone spent a long time making their strategy fit the past. And the past is not what you're trading. If you found this useful, subscribe. I post every week on Forex trading, market structure, and how to build skills that actually compound over time. And if you're ready to trade with a broker that gives you the honest execution environment these bots depend on, and to build the real skills that no algorithm can replace, check out the broker link and the course I recommend in the description below. I'll see you in the next one.